Well, four sources have told Reuters that at this Thursday's meeting, OPEC Plus is likely to extend its latest round of oil output cuts until the end of the first quarter of next year. OPEC Plus, which accounts for about half of the world's oil production, has been looking to gradually unwind production cuts through 2025. However, the prospect of an oil market surplus has exerted downward pressure on prices, with Brent trading nearly 6% below its average for December 2023. So where are oil prices heading next year? Well, to help answer that and more, I'm joined by Homayoun Falakshahi, Senior Oil Analyst at Kpler. Homayoun, thank you so much for joining us. So what are you expecting from the OPEC Plus meeting on Thursday, and what would you actually like to hear?
Actually, it's been a few months already that we've been calling for, OPEC Plus to delay their production schedule hike. As you know, they should have started increasing their production in September, October already. And so, the delays that have been coming for us, it's really not been a surprise. And we think it should be continuing simply because, looking at crude oil balances globally, looking at the fundamentals, looking at supply growth from non-OPEC Plus, it's not the right time now to actually go ahead and boost supply. So our expectation is that they should be delaying their decision to increase production once again. It could be a decision, to delay it by 1, 2, 3 months, potentially 1 quarter. But I think the decision making that has been in place over the past 2, 3 months, i.e., a short delay, 1 month or 2 months, has been quite efficient at limiting the downside, and so we expect that to continue.
Now, looking at prices a bit more closely, Brent seems to have been stuck between $70 and $80 for quite a bit of this year. Do you think that's likely to continue? Where do you think prices are heading?
Yeah, actually, I mean, again, the downside we think, will be determined by OPEC Plus action. If OPEC Plus in the end decides to go ahead with its production hikes, we should be breaking down, $70 for sure for Brent, but maybe even 60, or we could even test, the $50 range. So the downside will be limited, we think, by OPEC Plus action. It makes sense for them looking at their fiscal budget situation. They know that after 2025, there's not much growth coming from non-OPEC Plus country except for Guyana. So it makes sense, we think, for them to wait a bit longer, and that's the downside for prices. That's why we think the downside is limited for prices. So we see Brent, as down as, I would say, $70 per barrel on average per month next year. The upside also, we think, is limited. So we actually have we see the range remaining between 70 and 80, actually maybe between 72 and $77 per barrel. The upside being limited by weak fundamentals, and also Donald Trump arriving at the White House. In his first mandate, he was quite aggressive as soon as prices rose. And we think this should continue to be the same as during his first term, i.e., whenever prices, let's say, rise above $80 per barrel, he could be tweeting and pressuring OPEC Plus to go ahead and do something about it.
Now, what about supply from Russia? Its Asian imports are slipping, particularly because of China. Do you think Russia can carry on relying on this region?
Yeah, I think, even with the arrival of Donald Trump, and there's rumors that the war between Russia and Ukraine could see an end soon after he gets into office, we don't think there's going to be a change in policy from the EU. It's hard to see the EU going back to buying Russian crude. So Russia will have to rely by far overwhelmingly on Asian markets. That means really China and India, really. They still ship about 400,000 barrels per day to Turkey as well. But yes, they need to rely on these two countries. Looking at last month, you're right, there's been a drop in exports from Russia, about 250,000, 300,000 barrels per day. Month on month compared to October. It looks to me that actually exports to China are stable. So far, I think maybe the weakness will come. It sounds like it's coming from India, the fact that it hasn't been ramping up. The refineries haven't been ramping up as fast after maintenance. But yes, we think Russia will continue. And the other point on Russia is that they've actually been implementing their cuts since the beginning of summer, really, after strong pressure from Saudi Arabia. And they're actually getting closer to the compliance, to their quota target. So they're not there yet, but just slightly above that. They really got closer to their target.
And looking at the supply side of things more generally, how much longer do you think markets can sort of cope with being oversupplied like this?
Yeah, it's I mean, again, looking at the first, let's say, I think 5 months of 2025, we have a big surplus, on average of more than 1.3 million barrels per day over the first 5 months. So, quite a big surplus, even when comparing with 2023, 2022. And that means that markets will be pressured. That's why OPEC plus action is going to be extremely key and essential, to limit the downside. In short, I don't think there's a big catalyst that could, drive prices higher. There could be some sort of a bazooka, announcement from China again, but even that would be mainly short-lived because fundamentals in the short term are not looking good. Then in the second half, it actually starts to get slightly better, and also we should expect some impact of the Trump administration on Iranian supply. Our base case view is that Iran's supply decreases by 500,000 barrels per day from the summer of next year of 2025, and that means that from the summer onwards we should have a slightly more constructive market. But again, OPEC plus in the short medium term is going to be extremely key in order to limit the downside. Otherwise, we should see prices dropping.
Really interesting stuff. Homayoun Falakshahi from Kpler. Many thanks for your thoughts.